It's now my pleasure to introduce our main speaker today, my colleague from Spokane, Steve Scranton. Please welcome Steve Scranton.
Thanks, Jim, and thanks, everyone, for coming. I always get a little cautious when you have a stationary podium like this. It's an easier target to hit versus if I have a lapel mic where I can be moving around a little more. But hopefully the information I'm going to give you today, my objective today is to talk about 5 themes that I think are major themes over the next decade that we as businesses need to be prepared for, but also how that impacts us in 2012. So there will be my implied forecast as we talk about 2012. And then, as Jim said at the end, be happy to take questions and answers. So the first theme that I think will be a dominant theme, it already has been and will continue to be, is the theme of debt or excess debt and the deleveraging now that needs to go on in the developed countries of the world. And what that implies, the implication to me is that implies that we are going to see subpar economic growth from the developed countries for the next 5 years, and potentially, depending on the decisions or lack of decisions made by the world governments, could extend as much as 10 years as we work through the problem of debt. Because people need to remember that it's far slower process to reduce a debt problem than it is in a traditional business cycle where you just need to work off your inventory and move forward there. So the perspective I try and give people is that all of the developed countries, when you really look at it, the US, Japan, and Europe, all have the same problem. They massively inflated their debt trying to move their economies out of the financial crisis that we had in 2008, and now the bill is starting to come due, that debt is at an unsustainable level. What we've seen is the bill has come due in Europe, and they're dealing with that financial crisis right now. Japan is probably the next candidate somewhere over the next 5 years, and ultimately, depending on how the U.S. again responds, I think we're kidding ourselves if we think that 10 years from now, if we haven't done anything to resolve our debt situation, to take serious steps, that we won't be experiencing the problems that Europe is experiencing now. It's just that because we are the world currency, we are, the euphemism I like to use is we are the best house in the bad neighborhood. The money still flows to the U.S. right now, but that's not going to last forever. And the challenge for the U.S. directly, what I'm telling our businesses and everybody that we talk to for 2012, and really, like I said, for the next 5 years, you need to adapt your business model and your budgets to 1% to 3% economic growth. Because I think that is the type of growth that we will see in 2012 and into the extended future, because we have not dealt with our debt problem as of yet. And we see it especially from the consumer side. Consumer spending still accounts for 70% of U.S. economic growth. The consumer ran up massive debt during the 90s and the 2000s, using their house basically as their favorite form of leveraging up. That bill is now coming due for the consumer, and the problem that the consumer faces in the U.S. is that they have not seen essentially any salary increases over the last couple of years. In fact, on a year-over-year basis, when we look at real wages for the U.S., it's declined by 1.4%. So the consumers aren't getting help by seeing salary increases to pay off their debt. They're clearly not seeing it in their financial assets. Home prices are still falling, and I think we'll continue to see that. So the consumer is going to have to start pulling back on spending because they've used most of their savings. We've taken the savings rate, which was around 5% in the summer of last year, down to 3.5% by the end of the year. Well, that's a finite number. When you get to zero, you can't pull savings anymore. So I'm a little more cautious when the news media had all the hype last week about how it was fabulous that consumer credit rose at a record level to $20 billion for December. My view, being a little more pragmatic, is saying that's because they've run out of savings. They didn't get any salary increases. They had to fund their Christmas spending somehow, so what did they do? They tapped their credit cards. And so I'm at least concerned to say, the favorite phrase from Yogi Berra is deja vu all over again. Are we going to do 2011 in 2012, where everyone thought it was going to be a great start of the year, and what we actually found out is the consumer had to pay all those bills. We had very slow economic growth in the first half of the year, and then gradually started getting better. I see that potential again for 2012 because the consumer has to deal with that debt. The other, what I look at that from a business standpoint then is, and you can always look at two sides of the coin. Either it's a challenge or it's an opportunity, depending on what side of the coin you're on there. But what I would say essentially is that if you can adapt your business and your budgets to a 1 to 3% economic growth, the opportunities that you're going to see are things that come about from that type of subpar growth. You're going to see opportunities either from failed competitors who can't compete, or lower barriers to entries to get into businesses that maybe you've always looked at but couldn't afford to get into. So I would very much say that rather than taking the glasses half empty approach of saying, oh, this is never going to get better, if this is the economic reality we're dealing with, how do you take the perspective then of saying, now where's the opportunities I can take advantage of it? Because the one thing I would highlight throughout the history of the U.S., plenty of success stories you look at in the Puget Sound or anywhere else where the reason they were successful was they were looking for those opportunities during a time of crisis, and then they benefited as it went from there. The best example I could give you is technology in the 80s, when all of us during that time period remember that everyone said the U.S. was never going to be competitive, Japan was going to own the world, manufacturing was dead. What we saw was technology stepped in, provided a solution for business to be more efficient, and now we have people with cell phones that are 10 times more powerful than the computers we had back then at a tenth of the cost. So I think that's your opportunity as a business is adjust your mental mindset to say subpar growth is what we're going to be facing. Now how do I take advantage of that opportunity? Because that ties into the second trend, which what I see happening over the next decade is the continued globalization of the world economy. And the perspective I would give you on that, if you look at the information from the International Monetary Fund, in 1995, developed economies of the world accounted for 64% of global growth, and the emerging economies accounted for 46%. By 2010, the global economies were the developed economies were accounting for 53% of global growth, and the emerging economies were 47%. The International Monetary Fund projects that at the current subpar growth rate that they are also projecting, that by 2015, developed economies will account for 47% of global growth, and the emerging economies will account for 53%. So I would say, once again, given that reality, what you're looking at, especially that interconnectedness of globalization, in 2012, my simple answer that I would tell you is Europe is going to continue to dominate the headlines. And the U.S. is not immune to Europe. Europe has not solved their debt problem. It's going to continue to pop up, and they'll continue to try and kick the can down the road. But eventually, it's going to reach crisis proportions. And the U.S. can't just figure, well, that's Europe's problem, because the reality is one of the biggest strengths of our economy right now has been export-driven manufacturing. The statistics right now through year end is that U.S. export-driven sales, Europe accounts for 20% of our sales. So if Europe goes into recession, and especially depending on what severity of that recession, that will have an impact to the U.S. economy. The question is just how big an impact. I would very clearly say if we develop a financial crisis in Europe like we did in the U.S. in 2008, the U.S. will not be immune. Then I'd be changing and telling you to prepare for a recession. But right now it's just more of saying we will be seeing slowing growth because of our interconnectedness there. Longer term, as that trend continues, as the emerging economies continue to gain market share, the challenge for you is to figure out for your business, how do you tap in to those emerging economies? The opportunity is, if you succeed in figuring that out, that you're going to see, one, opportunities to be suppliers of machinery and equipment as they fund their growth to begin with. And then ultimately, you have the opportunity to position yourself to be the supplier of the final goods as those emerging populations, their relative quality of life continues to rise, they will become consumers. And they will be looking to buy stuff because they have access to the internet. And they're saying, I want that, I want that. So that's where I would say your opportunity once again is, rather than saying, oh, the U.S. is going to continue to lose market share, what we're already seeing, just in the immediate term, especially for 2011, the most successful companies in the economy were the biggest companies, the S&P 500 companies. And why is that? Two reasons. One, the average S&P 500 company, 40% of their sales were to international marketplaces. Plus, because they were selling internationally, they got the currency translation back as the U.S. currency showed depreciation, that they benefited there as well. So I think that is what I would say your focus should be on globalization, is how do you tap in to that new consumer base that you're going to have available there. The third trend that I would see tied into globalization is the secular decline of the dollar. And some people look at me before, what do you mean secular decline? And what I've tried to tell people is if you look at the index that tracks the dollar versus the a basket of developed country currencies, what we see is in 1985, that index stood at 160. 2010, that index stands at 80. So we've seen a slow, steady decline in the dollar, and it's going to continue to be, volatile, but I think that trend long-term will continue. The flip side, though, I tell you that for 2012, I think the dollar will actually be appreciating because of our friends in Europe. I think with Europe's crisis unresolved and continuing to grow, the euro will probably continue to decline. So in the short run, over the next 12 months, the dollar could see appreciation. But what I would tell you is you need to position your business for the longer term trend. Why I think you continue to see that decline in the dollar is two reasons. The first one is a fundamental reason that if you're a country that imports more than you export, you have a structural trade deficit. That, in and of itself, would cause your currency to depreciate versus the other currencies. The other thing that's in play, though, is that one of the strategies for countries throughout the world in history has been when you're facing a major problem of dealing with a debt situation, rather than making the tough decisions first of saying this is what we need to do, one of the first simple strategies, depreciate your currency. Try and grow your way out of the problem. Because if you depreciate your currency, then your goods are more competitive, you can sell more overseas. That is how the U.S. historically has always resolved its budget problems. Because it wasn't that severe, the debt wasn't that severe, we grew our way out of it by having currency depreciation. I would tell you, my belief is, tied into what Sam Reed just said, is that with the polarization we have in Congress now and no willingness to really cooperate right now, I don't lay out a lot of hope to tell you that in 2012 that the U.S. is going to address its debt situation in any serious way. It's an election year. We're going to be focused on politics and we're going to be focused on blaming each other for the problem rather than dealing with the problem, which I think sets up again that the U.S. then may pursue the strategy of continuing to try and depreciate its currency to achieve more growth and reduce the size of the problem. If you can knock off some of the problem through growth by currency depreciation, well, that makes the rest of the problem smaller. I think that's why I think the long-term trend is for dollar depreciation. And that ties then into the fourth theme that I would tell you that we need to pay a lot of attention to, even though right now maybe people aren't, and that is still inflation. But what I would tell you is I've got maybe a little different perspective than some people who, you read the articles about we're going to have hyperinflation, or we're going to repeat Germany and the Weimar Republic of seeing, hyperinflation. What I would tell you is that, I don't see that situation, and what I actually see for 2012, my view of 2012 is we'll actually see declining inflation, and in some cases we'll actually see deflation in certain areas. Because what is still happening in the U.S. is that hard assets are still depreciating. You see that very clearly in residential real estate. Home sales themselves look like they started to bottom. Home prices have not bottomed yet. In fact, for the Puget Sound region, King County, median price of homes in King County in December fell by 15%. So we're still dealing with foreclosures, distressed sales, things like that have to be worked through. So I think in the short run, and the fact that we're seeing the slowdown in the global economy, commodities prices are now coming off. We've seen copper drop dramatically. We've seen all the industrial metals really dropping in price. So I think that implies, again, on a short-term basis for 2012, we have a better chance to see declining inflation rates. I'm not going to tell you that I think we're going to have overall deflation, but I think the rate of inflation, which is at 3.5% now, will gradually be coming down. But I still think that the longer-term risk that we need to be prepared for is rather than waiting to see the whites of the eyes of inflation, you need to prepare now for longer-term inflation for two reasons again. The first one being that with all of the liquidity that the central banks of the world have dumped into their economies, right now that money is just sitting in bank reserve accounts because there's no loan demand. Businesses don't have confidence in what governments are doing, so money is kind of just sitting there. Banks have money to lend. People don't really want to borrow right now. So what we see is that the historical engine for growth for an economy, Federal Reserve puts money in a bank only has to keep 10% of those reserves, they lend out the rest. that what they call velocity of money is not happening right now. It's just stagnant. But at the point in time as businesses slowly gain confidence, get clarity of what the tax situation regulations are, that is the risk that, we're conducting essentially a human lab experience right now on economic theory. We've poured all this money into the economy. Can the central banks of the world really pull it out fast enough to keep inflation from rising? And I think that they will move quickly on that, but I think that we will still see higher inflation because the other reason, especially in the U.S., but the other countries as well, why we'll maybe see higher rates of inflation, something in the 4 to 5% range, maybe even 4 to 6% longer term. It's back to the same story again, is that when you're facing the challenge of how do I reduce my debt, and I don't want to have to tell my constituents that I'm going to raise your taxes, well then I'll raise them implicitly. Because by having inflation rise, then any borrower benefits. They're paying back their debt in inflated dollars. Savers are essentially taxed. They've lost purchasing power because of the inflation impact on their savings. So that's an implied tax that you don't have to announce to your constituents we're raising your taxes. It's done implicitly by letting inflation rise, and the Federal Reserve, at least right now, has indicated a willingness to let inflation rise to some degree. The question is, what's their magic number? And hopefully we'll see that over the next quarter as the Fed is going to actually start announcing more direct targets for both inflation and employment. But I think that inflation is still a long-term issue, that your challenge as a business is, again, there's a challenge or an opportunity. The challenge is, can you find ways to lock in costs for, if we do see declining prices for goods, that you can lock in some of your supply or other parts of your expenses for the longer term to have that inflation risk taken away, or are you not able to? Because those companies that are able to do that are going to have the opportunity then to be more competitive once inflation starts to rise. It's a story that we saw during the 80s and 90s with Southwest Airlines. They hedged their fuel costs. They did a fabulous job of it. So through the 90s and 2000s, they rode that wave of, I've already got my insurance policy in place. I protected against inflation. Now, those fuel hedges ran off. And what do we see? Southwest prices are just like everybody else's prices now. They're really not any cheaper anymore. So that's your opportunity as a business, is to position for inflation, view it as an insurance type of risk management thing, that rather than waiting for the event to happen, you insure against it now, and then you're ready, and it may cost you something to do that, but then you're ready when it starts to come along, that you're far more competitive than your competition. The last theme that ties into that then, the final theme, are interest rates. And we keep hearing from people saying interest rates are at historic lows, they've been here for 3 years, they're going to have to go up. I 100% agree with that statement. I just disagree with some people's time frame for that. I shake my head a little bit when I look at the Wall Street economists again, that those economists last year, at the beginning of last year, forecasted that we would see interest rates rising. And what we saw was interest rates coming down because of the Federal Reserve pushing rates down. Those economists are right back again, forecasting rates to be rising for this year. And I don't have any fancy econometric models or anything. I'm more of the Peter Lynch economist, that I just look at what I see on the streets, hear from our customers and everything. And what I would tell you by looking at what the Federal Reserve is saying, they have no intention of raising rates this year. They're right now saying mid-2013. I would be willing to bet you they may extend that into 2014, because what is happening that you need to understand with interest rates, and I'm not going to call it a conspiracy theory or anything like that, it's just the reality of strategy that I think is being followed. It's another case, if you're trying to deal with your debt problem, how do you do it without having to actually announce to your constituents this is what we're going to do? But what we have going on right now by the Fed artificially holding rates low, the phrase that's being used, and it's not my phrase, it's actually an economic phrase, financial repression. And what financial repression is essentially is another hidden tax. Because what we've done with the Federal Reserve holding rates low and trying to drive long-term rates even lower, we have basically taxed the savers we've got this strange message going on right now that we've told savers, if you were fiscally responsible and you save for retirement, congratulations, you earn no interest on your money anymore. I hope you make it. But if you were fiscally irresponsible and got yourself head over heel in debts, we're going to come up with every program we can think of to try and bail you out. But the bottom line is, what's going on from the government standpoint by the Federal Reserve participating in this, If they weren't holding interest rates where they are, 0% basically for short-term rates, they'd probably be more in the 2% range, maybe even 3% in an efficient market. So essentially what we've done is we've taxed the saver 2 to 3%, saying you should have earned 2 to 3%, you're going to earn 0. Thank you very much. We'll take that money, we'll pass it on to the borrowers, because you should be borrowing a mortgage rate at maybe 6%, and instead you've got 4%. Or the U.S. government especially. You've got this massive debt problem, and yet you're still able to borrow 10-year Treasury rates at 1 3/4%. That's financial repression. I would tell you that in the short term, the Federal Reserve is not moving off of that stance. And the composition of the Federal Reserve, governors and presidents who are voting this year are more geared towards monetary accommodation rather than being the more bearish side there. So I don't think there's anything that changes there. So from you as a business, your challenge is, once again, how that might affect your profit margin if you're tied to interest rates on collecting rent or things like that. But on the other side, it's the perfect opportunity to be having discussions with your financial institutions as to looking at, potentially diversifying your expenses, locking in rates over various time periods. And, that is something, once again, it's an opportunity, because for those that are able to do that, when interest rates do start to rise, and you'll notice I said when, not if, when they finally do start to rise, you've positioned yourself far better than having all of your borrowings either all long-term or all short-term there. So I think that the trend for interest rates for 2012, stable for short-term rates, declining for long-term rates. The Fed is still bound and determined to drive mortgage rates lower. And we may see another refinancing strategy being announced by the government trying to refinance more people. But over the longer term, and that may be 3 years out and maybe 5 years out, but over the next decade, the trend I would still tell you is you need to be positioned and ready for rising rates. Because on a risk-reward basis, you can't go much lower in rates, but you can clearly go higher. It's just a question of the timing, because when I hear people saying, no, we can't stay down here much longer, rates have to go up, my simple response is, remember Japan. Japan's had 20 years of 0% interest rates. So it is completely possible for that to happen. I don't necessarily argue that's the U.S. I don't think we're completely repeating Japan's mistakes, but I'm just saying from a perspective standpoint, you can be at these levels for a long time. You just don't go any lower, but that doesn't mean they necessarily go higher. But I think the trend is, over the longer term, rising rates. So in conclusion, I guess there's some thoughts that I would leave you with and then take questions from you. One, I would tell you, a piece of advice I would give you is that you need to go back and refer to your Aesop's fables. And this is a time period with this turbulent economy, with the uncertainty. You need to be the ant and not the grasshopper. You need to be preparing now for potential of a hard economic time period. If it doesn't happen, great, you're in good position. But if you're just going merrily along and saying, well, I hope everything gets better, my response to you is that hope is a critical emotion that all of us have. It's what kind of keeps us going in life. If we didn't have hope, we'd be falling into the pits of despair. Hope is not a strategy. You cannot base your business on the strategy of saying, well, what are you going to do about this? Well, I hope it gets better. Because if you base your strategy on hope, you've got a problem. So that's the first piece of advice I'd give you. The second piece of advice I would give you, something that came from one of our longtime customers. It's the best piece of advice when he said, look, World War II was far worse than this last recession. The difference is we didn't have the news media telling us 24 hours a day how bad it was. In fact, they actually told us about victories overseas. So my advice to you is turn off your cell phone, turn off CNBC, and focus on what's made you successful, your business. How does your business really get impacted by what the stock market did on a day-to-day basis? I doubt that it really does unless you're in financial services. So I would just simply advise you to roll up your sleeves, focus on what's made you successful, figure out how you adapt to this slow growth economy rather than worrying about what all the 24/7 news channels are saying. So I will leave you with those two thoughts. I appreciate your time, and I'd be happy to take questions now.
Thank you. I'm sure I'm speaking for most of the folks here when I say thank you. Many of us travel either personally or do business in Europe, where those of us who haven't turned off our cell phone and the TV yet are bombarded with the news of Unicredit in Italy and Spain. Is traveling to Europe, doing business in Europe, going to be cheaper this year, the next year? Is it going to be the same? What advice would you give us who are either planning on or budgeting for doing business in Europe?
I think, again, overall the trend, because Europe has not dealt with their debt problem, and I have serious reservations that they're going to deal with it in the near term, that should have the euro declining in value. And we've seen that over the last couple of weeks. So I would say from that standpoint, I think that the dollar in 2012, the trend will be more upward trending. So if you're dealing in Europe or traveling, it's going to be a good time because you've got cheaper currency there. But if you're trying to sell there, it's going to be a bigger challenge because we're more expensive in the U.S. now. Our goods are more expensive. But I think that will be the general trend. I think very volatile. But if you're budgeting as a business for doing business in Europe, I think you need to budget for your currency, the U.S. dollar, strengthening rather than weakening.
To what extent will demographic changes and entitlement programs impact the global economic situation, say 5-10 years out?
The biggest challenge facing the world as a whole in the U.S. is entitlements. It's the third rail that nobody wants to touch. And yet that's the rail that you're saying, we've reached a point, the message I try and give people is, look, it was great while it lasted, but there is no easy answer anymore with the debt problem. Entitlements are going to have to be changed in some form. And I think that is something that the more people resist it, I think the biggest problem that we face right now is that the average American doesn't understand the true issue. They don't understand that the U.S. takes in about $160 billion in revenue every month and spends $320 billion. Somewhere, you got to come up with how you're going to pay for that. And if you're not willing to raise taxes or expand your tax base to take in new taxes, then it implies that there's spending cuts, which means entitlements have to be reduced. And, the one perspective that I would give, and this is a case, I guess I can duck under the podium if somebody's going to throw something at me, but, the facts to give people of what was the true intent of Social Security. Social Security, when FDR put that in place, had a minimum retirement age of 65. Well, average life expectancy at that point in time was 61. So what it was designed for was not as a retirement fund. It was designed as a safety net to say if you live longer than the average, because that was strictly the average life expectancy, the government would be there to help you. If we were going to carry that forward to now, average life expectancy is 79. That would mean that the minimum retirement age would be 83. If that was truly what was put in place, we would have no funding issue with Social Security. We would be literally fully funded. But that's an education thing again. You can convince me that the American public will ever buy into that. And we're already seeing the real life example when Greek citizens who are being told, guess what, you can't retire at 45 anymore and get full retirement benefits, and they're having riots. That's that whole, how do you change the entitlement mentality? It's a tough process, but that's what ultimately has to be dealt with. Yes?
Thank you. As a small business owner for over 35 years, I want to compliment you for what you said. I'm going to go home today and tell my wife of 35 years that what she says about not listening to the news, not focusing on all the negative things, is detrimental to mindset for business. Thank you.
You're welcome.
There looks to be a lot of opportunity in emerging markets that are getting stronger now, but at the same time, many of them are dependent upon European banks. What's the likely impact of a European meltdown on emerging markets?
The emerging markets, contrary to what some strategists would tell you, I don't believe the emerging markets have decoupled from the rest of the world. No different than the U.S. hasn't decoupled from Europe either. We're all interconnected, so that if there's a financial crisis in Europe, the emerging markets will suffer less. But less is a relative term. If you're used to growing at 8 or 9% like China, and you drop to 5 or 6%, from their citizen standpoint, that is going to be a hard landing. That's going to be say, this is bad times. So I don't think the emerging markets, they're still developing. That's why they're emerging. They're not strong enough yet to be able to say, we have diversified our exports to a vast variety of countries, so Europe's not going to affect us. Europe is something the whole world should care about because everybody's going to be affected if Europe doesn't get its act together.
A lot of people are talking about employment increasing. Is it real or is it a mirage?
No, I think employment is increasing, but not at a fast enough pace to generate strong economic growth, and probably not at a fast enough pace to really bring the unemployment rate down dramatically. A lot of the declines in the unemployment rate that we've seen over the last year, we tout that we've gone from almost 10% to now we're down to 8.5%. If you had the same size labor force, meaning people didn't get discouraged and just stop looking for work, we would have still close to a 10% unemployment rate. What we have to understand in the way the government calculates employment, you have to be looking for a job. If you've just given up, said, forget it, I've tried, I can't find any, you are not unemployed. You're just not looking for work. And so when the labor force shrinks, the unemployment rate comes down, just on pure math. So I think that we are seeing job growth. It's averaging about 100,000 a year. The statistics have shown that just based on the population growth of the U.S., as people are graduating from college and forming new households, you need 150,000 to 200,000 to truly bring the unemployment rate down. So what we're doing is kind of treading water, that we're creating jobs, but we're not doing it at a fast enough pace. And so what we're facing is the true potential, especially if we can't address entitlements, don't deal with our deficit in a timely fashion, we will look like Europe. Europe has a chronic unemployment rate of 7 to 8% because of all of the social programs that they do offer. And I think that is something that I've just tried to tell people. It's a choice you've got to make. 100,000 jobs a month isn't enough to put people back to work, because the one thing that we saw very clearly is we put 8.5 million people out of work in the recession. We've only hired back 2.5 million. There's still 6 million people because businesses are focused on efficiency. It's cheaper to replace my computer and my hardware and be more efficient than to hire a new employee and not know what my health care costs are going to be, not know what regulations are going to be, that type of thing. So I do think that employment growth is real. It's just subpar.
You made some comments that made me think about moral risk and people holding debt, particularly in houses. The Feds pushed hard last week for something, I don't know what. Are you hearing anything that may lead you to believe that there's going to be significant rethinking as to what's being done with the whole portfolio of housing in distress?
The rumor that you hear running around is that, the Fed tried to put the pressure on Congress saying, look, you guys need to let Fannie Mae and Freddie Mac take more losses because we need to work through all these foreclosures and we need to get this process going. Congress promptly chastised the Fed of saying that's none of your business. You're tasked with, stable employment and stable inflation. But, the rumor that's been bouncing around, and I think there's a little more than a rumor to it, is that we may see the administration oust the current head of the Federal Housing Authority, who oversees Fannie Mae and Freddie Mac, bring in somebody who's more willing to say, hey, yeah, we'll let Fannie Mae and Freddie Mac run up bigger losses to try and help out the housing market. So I think it's very clear the Obama administration is adamant they want to figure out a way to have more Americans be able to refinance their debt. The Fed has made it clear that they're essentially going to offset whatever negative impacts that may be, because if you have a huge refinancing boom, that means anybody who owns those mortgage-backed securities takes losses because they get a huge prepayment. So the Fed is essentially saying we've got in our hip pocket, if that happens, we'll come back in with quantitative easing 3 and buy up a bunch of mortgage-backed securities to support those prices. So I think that's what's going on, and that's why the Fed hasn't done anything. They're waiting to see if the administration is going to do something that will have a negative impact to mortgage-backed investors. I think we're at our time. I see it's 1:25. One last question, I guess.
Last question here.
Good afternoon. Thank you very much. With just over 80% of the U.S. GDP being driven by the consumer spending, and with the globalization of the world economy, what advice would you give to us as our best investment in action towards long-term fiscal sustainability?
And you want that in 1 or 2 minutes, right? My bottom line continues to be is that we have far past the point of an easy answer to our debt problem. And so all the answers are ugly answers, but we're going to need to, say, hey, we can't keep supporting all these programs, this deficit spending. We either need to come up with more revenues or not, and we clearly can't rely on the consumer. The consumer had almost 30 years driving this economy. Reverting back to the mean would imply we could have 30 years where the consumer has a far diminished role. So if anything, I would say the type of fiscal policies that we should be pursuing is, how do we support businesses to get them competitive, able to access those foreign markets, have better exports, so that manufacturing takes on a bigger percentage. I'm not arguing that we'll come back to where manufacturing was back in the 50s and 60s, but to bring manufacturing and the whole export-driven part of our economy to a stronger presence or stronger part of the economy and less dependent on the consumer. And that, in my book, means we need to change our attitude of calling business the root of all evil, and we need to instead focus on saying, how do we remove barriers for small business especially, since small business over the last 35 years has accounted for 60% of job growth? How do you help a small business become successful, rather than how do you impose more regulations? And that's my sermon for the day.
Seattle Rotary Online is made possible in part by a grant from First Choice Health, working with the Washington Health Information Collaborative to use technology to bring better health care to patients throughout the Pacific Northwest. First Choice Health.